The arithmetic on this sector's performance doesn't match the rhetoric we've been hearing from Washington. While politicians promise energy abundance, the numbers reveal an industry caught between contradictory forces. Record production alongside the steepest job losses in 3 years. I'm Mark Roach, and this is FutureWise Energy. Oil has surrendered ground to 4-month lows. WTI sits at 61.60. Brent at 65.09, both down 17% from last year's levels. Now, natural gas provides the only bright spot at $2.93 per million BTU, up 16% annually. The downstream story gets starker. Distillate inventories are tightening while refiners struggle with margin compression. Here's where the contradictions pile up. U.S. crude production hit record levels of 13.4 million barrels a day, yet the rig count dropped to 424, down 13% year over year. Oil rigs specifically fell 20 units despite output gains. This isn't about efficiency anymore. It's about operators who've moved from drill baby drill to wait baby wait. Companies refuse to expand at current price levels and hover near break-even thresholds. The workforce reduction tells a brutal story behind these efficiency gains. Industry employment plunged 1.7% in August alone, with over 6,000 positions eliminated from the energy services sector. The broader sector shed 9,000 jobs through August, a 30% increase in layoffs compared to previous years. ConocoPhillips plans to cut up to 25% of its workforce, potentially 3,250 positions. Chevron targets 20% reductions by 2026, affecting 8,000 to 10,000 workers. ExxonMobil eliminated 2,000 jobs. This isn't temporary belt tightening, it's structural transformation. Companies now produce 47% more crude and 45% more gas with 37% fewer workers than in 2014. Artificial intelligence and automation are simultaneously driving energy demand through data centers while eliminating traditional energy jobs. The sector now consumes 140 terawatt hours annually through AI infrastructure, accounting for 3.5% of U.S. electricity consumption. The supply strain constraints add another pressure point. Natural gas turbine manufacturers face order backlogs extending to 2029 to 30. Threatening over $400 billion in planned gas-fired plants expansions. This bottleneck directly contradicts AI energy expansion needs. It creates a critical gap between electricity demand growth, projected by 25% by 2030, and the infrastructure required to meet that growth. Meanwhile, the federal government shuts down and disrupts operations on public lands, while Trump administration processes permits for conventional energy projects under emergency authorities. These skeleton crews that are doing this at the Bureau of Land Management and offshore regulatory agencies, they're operating slower and they're slowing down long-term development plans. State-regulated private lands remain unaffected, but federal permit delays impact offshore and Alaskan operations. Consolidation in the industry continues, reshaping the landscape. Upstream M&A reached about $207 billion in 2024, a 330% increase from the prior year. Now, this wave reduced the number of top public E&P companies from 50 to just 40. Now the merger frenzy is slowing as companies focus on efficiency and scale rather than growth, with fewer attractive targets remaining on offer. Now, cost inflation threatens America's position as the marginal global oil supplier. U.S. shale break-even costs are projected to soar, from over $70 to $95 per barrel by the mid-2030s as core inventory depletes and operators move to less economic drilling locations. That means our geology, the sites that we're drilling, are not as robust as the ones that we have been enjoying over the past 10 years. Now, major U.S. oil companies increasingly look overseas for cheaper reserves and labor, with international projects offering manufacturing wages averaging $2 per hour, say in the Philippines, versus $27 per hour here in the U.S. Small independent producers face existential threats from regulatory compliance cost. Let me repeat that. Small independent oil and gas producers here in the U.S. face existential threats, meaning, that's a big word, meaning they're having trouble surviving this price environment because of regulatory compliance cost. New methane monitoring requirements impose technology cost that marginal well operators just can't afford. Those wells that these operators are operating, they account for 11.3% of U.S. oil production and 8.3% of gas production across, now get this, 770,000 sites. These sites are operating on thin margins, and they're making additional regulatory burdens potentially devastating. This disconnect between political energy rhetoric and market realities continues widening. Now, despite administration promises of energy abundance, producers maintain that only sustained higher prices, not deregulation alone, will drive meaningful production increases. Current oil prices near $60 to $65 per barrel remain below the comfort zone for sustained U.S. shale growth, with many operators requiring $70 minimum oil for profitable development in remaining inventory. The industry's strategic evolution transcends domestic job creation narratives. True energy dominance operates across borders through international reserves and supply chains that respond to market economies rather than protectionist rhetoric. While politicians fixate on bringing operations home, global energy companies navigate complex webs of international law, joint ventures, and cross-border partnerships that defy simplistic explanations. The real power lies not in protecting American jobs at uncompetitive wages, but in securing access to the world's most profitable reserves, regardless of geography. This interconnected reality cushions tariff chaos and presidential or executive orders that are volatile, and because cheap oil flowing from wherever it's most efficiently produced, it underwrites and cushions, comforts the American consumer and the commuter economy much of the excess that defines American prosperity. The market doesn't care about flag waving. I mean, Guyanese crude costs half what Texas shale demands, and neither do shareholders care. They respect returns over sentiment. I'm Mark Roach, and this is FutureWise Energy. Navigate accordingly.